US stocks and gold rally after the Senate voted to end the longest ever US government shutdown. New Zealand's economy is stirring back to life, and Australian unemployment is expected to fall slightly. That's coming up in our 5 Things in 5 Minutes on Tuesday, November the 11th. And then in our deep dive interview, ANZ FX analyst Kausani Basak explains why the Philippines peso has weakened through a key level in recent weeks.
Downside growth to risks and likely persistence of a dovish monetary policy has contributed to a weaker currency.
But first, in 5 and 5 with ANZ, the US government shutdown appears to be ending, with 8 Democratic senators voting last night with Republicans to resume paying federal workers, until January at least. ANZ senior international economist Tom Kenny says a factor breaking the 40-day-long stalemate was an escalation in delays at US airports ahead of the November 27 Thanksgiving holidays, the biggest travel week of the year.
We're seeing considerable delays at airports at the moment. In some of the major hubs, we've been seeing delays of up to 4 hours, and also seeing some flight cancelled. And this week, they did announce that they intended to cut flights by around about 10% in 40 major hubs there. So that could have quite a profound impact on travel, especially as we're heading into the holiday Thanksgiving season.
As at 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.8% and the Nasdaq up 1.5%. The yield on the US 10-year Treasury rose 1.4 basis points to 4.109%. West Texas oil futures fell 0.3% to $59.56 US a barrel. Gold rose 2.2% to $4,098 US dollars an ounce. The US dollar index rose 0.1%. The Aussie dollar rose 0.4% to 65.19 US cents with that risk-on move. And the Kiwi rose 0.1% to 56.32 US cents. Number 2. So how much damage has the shutdown done to the US economy, given it was the longest ever at 40 days versus 35 days seen in the middle of Trump's first term? Here's Tom again.
If we go off the 2018-19 shutdown there, the Bipartisan Congressional Budget Office estimated that shutdown, which lasted 35 days, knocked off about 11 billion in GDP in the short term. But over the longer term, they estimated that hit to growth was around about 3 billion, as there was some callback in activity. Look, given that this has lasted a little bit longer, I suspect, we're looking at a number higher than 3 billion, possibly around 5 billion over the longer run.
Number 3. ANZ New Zealand's chief economist Sharon Zollner has noticed a change in tone, rising up in chats with business leaders around the country. After years of surprisingly weak consumer spending and construction activity, there are signs of life, she says.
Things are definitely changing and changing quite quickly. So some offshore are still punting that rates are going to go a lot lower. One or two seem to have a religious take on where the neutral OCR is, whereas I'm much more agnostic on that point. If you look at things like Google searches for builders or joinery, that sort of thing, plus job ads, anecdotes, though they're hard to measure and even harder to seasonally adjust. Certainly the stories there are changing. I would say our card data too. We'll get our card spending pack out this week, but there's certainly signs of life in discretionary spending. That was evident already last month, and we'll get an update on that out this week.
Number 4. Sharon says the construction sector appears to be turning in particular, with consents 15% above where they were a year ago.
It doesn't just look like volatility, it actually looks pretty real. And that's consistent with the increase in card spending at architects that we reported last month as well. So certainly things seem to be turning around in the construction space, which is the most cyclical part of the economy, really, the most sensitive to interest rates. So that's definitely a sign that monetary policy is working.
Number 5. Australia is expected to report on Thursday that unemployment fell slightly to 4.4% in October from 4.5% in September, with monthly jobs growth flat at 15,000, says ANZ economist Aaron Luck.
Last month, the unemployment rate unexpectedly climbed from 4.3% to 4.5%, and that's mainly due to a large increase in the number of unemployed people, rising by roughly 34,000. But it is pretty rare to see 2 consecutive months of large increases in the number of unemployed. So we're expecting a small decline in October, which should see the unemployment rate dip slightly to 4.4%.
Aaron Luck there. Now, in our deep dive interview, ANZ FX analyst Kausani Basak explains why the Philippines peso has weakened through the key level of 59 to the US dollar in recent weeks and will remain under pressure, especially now that the Banco Central Filipinas, the BSP, has pulled back from intervening to protect that level.
The reason that this is notable is because the BSP has defended the currency at this level several times earlier. downside growth to risks and likely persistence of a dovish monetary policy has contributed to a weaker currency. The external account pressures are also unabated. At the same time, the BSP has also expressed that they now have a greater tolerance for a weaker PHP, which is adding to the weak performance.
Why do you think that depreciation pressure will continue?
So there are several factors to this, and the most important one is that the downside risk to growth have increased. The primary headwind for growth is the likelihood of a tighter fiscal policy due to the governance issues in flood control infrastructure projects. Government sources are estimating that approximately 70% of the funds allocated to these flood control projects over the past 2 years are unaccounted. So in response, the government has established an independent commission for infrastructure to investigate these irregularities. And also in the budget for 2026, the Department of Public Works and Highways budget has been reduced by about 252 billion pesos, which is a 29% decrease from 2025 levels. This will be done primarily by ending some locally funded projects. This measure is expected to weigh on the total infrastructure spending, and infrastructure spending has been a key growth driver in recent years.
And what has this done for the outlook for monetary policy? With the fiscal policy tightening, how is that likely to be responded to by the Philippine Central Bank, the BSP?
As growth concern has risen, the BSP has also adapted its monetary policy stance. It unexpectedly reduced the policy rate by 25 basis points in October, and it has also indicated towards further cuts. This has led to a market reassessment towards a more extensive rate cutting cycle. We are now anticipating easing cycle to extend to Q1 of 2026 with 2 additional cuts of 25 basis points each. The BSP has also revised its inflation forecasts lower for 2026 and 27. As a result, because of these lower inflation forecasts, the central bank will not have to intervene aggressively to dampen the import price pressures.
And can you tell us about the external position and how that is factoring into the situation?
Philippines' external account is not encouraging. While export growth was strong, the commodity-wise breakdown reflects that this improvement was largely driven by 27.9% increase in electronics exports in September, while non-electronics exports posted a more subdued growth of about 3.7%. Import growth has also moderated in the recent months compared to the elevated levels that we saw in early 2025. Now, we expect that electronics exports will remain resilient, supported by the ongoing AI upcycle. However, exports of other product categories are likely to decelerate further. On the import side, subdued infrastructure spending and lower commodity prices are expected to keep the import bill contained. Services account will likely continue to be supported by the remittance inflows, which will help offset the slowdown in earnings from business process outsourcing and tourism. And we are forecasting a current account deficit at 3.4% of GDP for this year. Now, the external account outlook is also not very robust. FDI approvals in the first half of 2025 only amounted to 95 billion pesos, which is significantly lower than 344 billion pesos, which was approved during the same period in 2024. And also, sentiment has deteriorated, which suggests that FDI inflows will likely remain weak for the remainder of the year.
Kausani Basak there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, November the 11th. Catch you tomorrow with a look at what the Fed thinks about how AI is changing the US economy. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.